G'day folks, welcome back to another update for gold and silver. Now it's breaking new highs, still rising on both charts, on the daily at least. Watch that divergence though, we've still got bearish divergence playing out along all daily and hourly time frames as well. Before we go any further, make sure you hit that like and subscribe button to support the channel. And also don't forget to reference the +1 videos to get a deeper dive into some of the trading strategies which we cover. So as of October 7, 2025, gold remains near record highs around $39.60 per ounce, driven by central bank buying, a softer US dollar and persistent geopolitical risks. Silver is tracking higher alongside gold, supported by industrial demand and renewable energy applications, while both metals benefit from safe haven flows, elevated valuations and potential shifts in interest rate or growth expected to trigger short-term corrections. Overall, the geopolitical backdrop continues to favour defensive positions in precious metals. And here we've also got a chart showing the year-to-date percentage change, showing gold and silver outperforming all those other indices for the S&P, the Nasdaq, the Nikkei and the Euro stocks. So first looking at the gold charts, and we'll always look at the long-term charts first, so the weekly here, and you can see there the price is very strongly bullish still, although we notice on the CCI1500 down here, those highs are falling lower. So we've got a declining CCI versus a rising price chart. And what we do, that's called a bearish divergence. So we expect it to pull back. Now again, I've already drawn a target range there, but that needs to be adjusted slightly. But what we do is we take a Fibonacci, assuming it pulls back from where it is at the moment. We take it back to the significant low before that divergence started. And that's where I would put that target range in at 23-38% range as a minimum for it to pull back. So at the moment, again, very bullish at the moment, but just be cautious. We've got a bearish divergence on the weekly. On the daily as well, first off, we did have this resistance back here at 37.91. It broke up through that resistance, and we're currently seeing a potential resistance at that point there. So I've moved that to that point. And also notice here we've got a bearish divergence as well on the daily. You've got a slightly declining highs there on the CCI versus the same period on the price chart, higher highs, and that's a bearish divergence as well. And if we were to draw a Fibonacci on this one, assuming it pulls back from where it is at the moment, I'll take it back to that low, and we can expect a pullback somewhere in that range, which happens to also be that moving average range. So that's a bearish divergence, so just be cautious. If it starts pulling back, again, it could break further high, like as it has been doing in the last couple of months actually. It keeps rising, but if it does pull back, that's where we can expect a minimum retrace. On the hourly, again, we had a bearish divergence here. Now this hasn't really pulled back much, because if I drew a Fibonacci there, this could have failed. That's risen to that point. In fact, what we can do with this one, you would just keep expanding or extending that trend line as you keep going. Now this point keeps going there. Let's see if that touched it first before we extend it. Again, from that high down to that low, you can see there it touched that 23-38% range. So that may have already played out its bearish divergence. And that's all it needs to do. Sometimes it just kisses it, other times it breaks into that range, other times it falls right through, and we can't tell how far it's going to fall. That's why we don't trade these. But in this case, that bearish divergence actually worked, and it looks like the CCI is now moving in line with the price. However, having said that, I'm going to draw another divergence in that range versus the same period. Again, I won't draw the target. Starts pulling back into that moving average range, then we can start drawing a target with a Fibonacci down to that level. So that's the 1 hour chart. So always pay attention to the divergence when you're trading these. Now we look at the back test, and what I've got here, I've got ideally you would have gone long from that point there when the daily price and CCI started breaking to the upside. During this period, notice that consolidation on the price, whereas the CCI was dropping off. That's a bit of a risky move to take. Now in this case, I've left that back test in there to show that this worked quite nicely. And the reason this worked is because of this roller coaster event, this consolidation period. If that had dropped, kept falling, you would have found your drawdown would have kept the profitability on the drawdown would have kept falling as well. So very risky to trade these areas. I like to make sure that the moving averages, like in this case, start moving apart, and you can start trading that, and that's what we've done here. But in either way, that consolidation period worked well throughout the whole period, and then it started working more fluidly with less drawdown and less drawdowns during that period. Now, just a bit of a takeaway. I've had a couple of questions asked in terms of getting clarity between these moving averages on both the daily and the hourly. Remember, the number one rule is we trade in the direction of the higher time frame. So we trade the hourly in the direction of the daily. So here you can see the daily's bullish, so we take only long trades. Now, the other thing too is you pay close attention to the CCI on the daily. And at that point there, that would have been the latest point you would have got out of the long positions up near one of those red candles there. And that would have been a nice little trade to take. But at the same time, you also let the hourly price and CCI moving averages work. And that's why I like zooming out a bit on the 1 hour chart in this case, because you can clearly see declining highs there on the CCI versus higher highs on the price. That's a bearish divergence. So, and you wait for the price to start breaking below. Now you can see there, just at a 50,000 foot view, those moving averages are still trending upwards. You probably would have got out of it somewhere in that range there, even though the CCI was dropping off. That was giving a warning. So that you treat these like a warning. And when the price breaks and the moving average starts to bend down on the price on the 1 hour chart, that's where you would have got out probably ideally at that point there. And that equated to that red candle there on a daily. So don't just go by the daily break to the downside. Follow the hourly at the first point when it starts bending, when the moving averages start bending down, and then going long again when the moving average of the price and the CCI start bending up, taking long trades, and then closing out again when both the CCI and the price start bending down, but especially the price there. So silver's been doing really well also. So here on the weekly chart, very nice strong bull run up through past the moving averages and the CCI likewise. But again, similar to gold, we just extend that trend line to that new high on the CCI. That's still declining versus the price. So that's still a bearish divergence. And again, I won't draw the target range for that yet until it starts pulling back, probably somewhere in around the 4,400 level. On the daily, again, similar thing happened. We've got a movement on the resistance up to that new level there at around about 48.78. And we're going to raise that trend line. This is actually not, we're going to extend it, but it's only risen very slightly. And that's probably about a double top there on the CCI. That's still a bearish divergence. So as soon as it starts pulling back around about the 46.50 level, I'll start drawing a target range. So at the moment, very cautiously bullish, but notice the CCI about to touch that moving average range. So that might be a caution just to avoid going long at this point. And by that stage, we should see the price break through the resistance as well. On the 1 hour chart, again, the first thing we will look for is any divergence. You can see there the CCI is dropping off. It's a bit hard to see, but there is a declining highs there on the CCI from that point to that point versus a double top on the price. That's a bearish divergence as well. Both the price and the CCI have dropped below the moving averages. And in this case, I will draw a target because that's already started to pull back. And we'll take it back to that range there. And we can expect, if it does pull back from here and continues so, we can expect it to hit around that 23-38% Fibonacci range. And back here we had a bearish divergence, hit its target, and the CCI adjusted. Now we go to the back test. And again, notice here we've got two arrows going long from either one. And again, paying close attention to especially the price, but also the CCI on the daily. And you would have got out the first period there on the daily at the latest, but also paying close attention, again, zooming out at this point, seeing a rising moving average on the price versus a declining CCI highs. That's a bearish divergence at that point, and take it to that peak, and you would have got out of the trade at the latest, somewhere in that range there, that which happened to have no contracts open as well. Now you'll notice I'm using average down approach as opposed to buying at a particular spot and putting a stop loss just below it. That doesn't work as well. In this case, you've got to give it time to breathe and that's why I follow the moving averages on both the daily and the 1 hour chart in this case. And whenever it retraces somewhat, but it's not yet fully broken to the downside, I'll average down. You can see there's a few average downs happening throughout that period. This was a bit of a drawdown here, but again, notice what we saw at that point. We started seeing the bearish divergence, CCI dropping off. In fact, that was the first indication when you started seeing almost a double top there versus higher highs on the price. That was your first indication. And this one back here, you would have got out of the trade when you start seeing the moving averages there drop off on the CCI and the price. And you would have got out maybe with a couple of contracts open at that point there before that drawdown. And that's where both the CCI and the price pulled back, then started getting back into it. But then you would have noticed another bearish divergence building there. And again, wait for the moving averages, especially on the price, pulling back with the CCI. Make sure you hit that like and subscribe button. And if you enjoy the content, subscribe at least on the free trial to my Patreon page, where I publish weekly bullish shares across various regions of the world's markets. Thanks, and talk to you in our next video.